Hello, everyone. Welcome to another episode of Inquisitive Finance. I'm your host, Rafael Negron. Today, we're going to talk about the federal fund rate. Now, the federal fund rate is something that I've heard about for many years, but I've never truly understand the way that it works. So I'm hoping that in today's video, I can try and distill this information in a way that's easy for you to understand and in a way that's very structured. So since my 30-day challenge, where really the point of that was just to upload a video every single day, I've taken a little bit of a break, but not because I wanted to stop, but because I think from now on my schedule will probably be 2 videos a week. This gives me more time in between videos to do some research, really take more time to be able to give you the best information that I've been able to find, and hopefully learn a thing or two myself, so that way when I talk about it, I can also better explain it to you all. So I just came back from the gym. I'm feeling pretty pumped up, and it's a beautiful day here in South Florida, as you all can see. Typically I film at night, but I was able to get home a little bit earlier today, and I'm just really excited to film this video. So without further ado, let's get right into it. And if you like the content, if you like the new framework, let me know in the comments below, and let me know what else you'd like for me to talk about. I'm constantly trying to learn about new things, whether it be on Twitter, or about things I read about, or even about things I just hear about. So let me know in the comments below. Let's start a healthy debate, and let's just have fun with it. So without further ado, let's go ahead and get right into it. So what is the federal fund rate? Okay, well, it is the benchmark interest rate in the US economy. Now, as many of you might already know, as of Wednesday, October 29th, this is in the range of 3.75% to 4%. Now, you can see, as always, I have some articles here that I've brought up, and you can see here it says the Federal Reserve on Wednesday lowered interest rates for the second time this year in a continued bid to prevent unemployment from surging. Fed officials voted for another quarter-point rate cut, lowering their benchmark lending rate to a range between 3.75% and 4%, the lowest in 3 years. It is the first time since the Fed's rate-setting committee was established in the 1930s that officials have set monetary policy while lacking an entire month of crucial government employment data due to a government shutdown. So that's sort of a very high-level definition of what it is. Now for this next section, I'm going to go over these 5 points that I've written out here and a little bit about what this overnight thing means, and then I'll go to a different website where I can show you, I guess, a little bit of a doodle of how I can picture it in my head. It just helps me maybe understand it a little bit more. Okay, so banks trade within this range when lending each other money overnight. So banks keep money at the Federal Reserve, like each bank's checking account, just like you might have your own checking account at your preferred bank. By law, banks must keep a certain amount of reserves to ensure they can cover withdrawals and other obligations. And at the end of the day, some banks have extra reserves and some are short, and they might be short perhaps to loaning out more than they anticipated. The banks that are short can now borrow from other banks that have extra just overnight. The interest rate they charge each for the one-night loan is the federal fund rate, right? So that rate that we just talked about, the 3.75% to the 4%. Now, let's think about why it's overnight. Well, it's overnight because one, banks settle balances daily, so they just need coverage until the next morning. It's meant to be short-term liquidity, and finally, it keeps the system stable and makes sure that no banks fail to meet their reserve obligations. So you can imagine all these different banks have obligations of their own. I'm sure that apart from this, they also have a lot of other things that if I do more research, I can probably learn about. But it seems like they all have to have a certain amount of reserves every single morning. And this is why these loans are only sent overnight. Every single day, they need to make sure that they are whole. So some banks at the end of the day might have more, others might have less. So when the ones with less get the ones from the more, pretty much that is how the ones with more are lending the money out to them. Now let's go back to this picture that I was telling you about. So it's one of my favorite websites, Excalibur. I actually drew this up last night instead of having to do it live. I think it'd be easier if I just show it to you here. So the way that I see it is you have the Federal Reserve, and each, let's say, bank has like their own checking account in the Federal Reserve. So again, going to what I just said, if Bank B is short and Bank A has more, Bank A can ask for a loan, or rather Bank B can ask for a loan from Bank A, and it will move the reserves from its checking account A here to B. Now it will send over that principal, and then the next day, so overnight, Bank B will repay that principal back with that interest. Again, that interest being the federal fund rate of, right now at least, 3.75% to 4%. So I think with all that, we can at least get a little bit of a better picture of what the federal fund rate is. Now let's move into something that I think is more important, and that's why it matters. Well, it influences almost every other interest rate. For example, credit cards, mortgages, car loans, savings accounts, business loans. Probably all of us are very familiar with these top 4, and I guess unless you own your own business, I do not own a business, But if you do own your own business, then business loans will be very relevant to you. So think about this, right? A lot of Americans have credit cards. Probably people all over the world have credit cards. They're constantly dealing with debt. They're paying them off every month. They're, reaping the rewards, whatever it be. But we're all very used to having credit cards. Every time you issue a new credit card or you sign up for a credit card, there's that APR, that annual percentage rate. That rate is governed, or at least guided, by the federal fund rate. Or things like a mortgage. Some of you may own a house, right? I own a house, for example, and luckily for me, I was able to get it during COVID, which meant that interest rates were lower. But now we can see that interest rates are a little bit all over the place for mortgages. But these mortgage rates are, again, guided by the federal fund rate. And I'll dive a little bit more specifically into mortgages later. Then we have things like car loans. A lot of us pay for our cars, which I think, by the way, one of the best things I did was to just pay off my car early. And I've been driving the same car for 8 years. I plan to drive it to the ground because I really love not having a car payment. And then things like savings account, right? So something like a high yield savings account that you might have. The interest rate that you gain from the money that is sitting there is, again, guided by the federal fund rate. And then we have business loans. Okay, let's go back here. So when the rate is increased, borrowing becomes more expensive and slows down the economy. Let's think about that. When the rate is increased, borrowing becomes more expensive and slows down the economy. So what does this mean? Well, it helps fight inflation. When there's a lot of cash and credit flow, people spend more. If the supply cannot keep up with the demand, prices rise. And that makes sense, right? Imagine the economy is doing very well. People are spending a lot of money. The economy is very stimulated, very, very high demand. But all these goods and services, maybe they start to run out. So when there's such a demand on these goods and services, the prices of these goods and services begins to increase. So to help fight inflation, we can lower the federal fund rate, which makes borrowing a little bit more expensive. That helps sort of slow down the economy. And the opposite can be said too, which, by the way, for a lot of these things that I'm talking about, anytime I'm talking about the federal fund rate increasing, the same can almost be said for the exact opposite. What happens when the federal fund rate decreases? In this case, when the rate is decreased, borrowing becomes cheaper and it helps stimulate the economy. So it can do something like help fight a recession. Okay. Now let's move into who it impacts. So these are different personas you can imagine. So let's talk about consumers. Consumers through higher or lower loans and savings rates. That's how it impacts consumers. So imagine the credit card interest rate goes up, which means that carrying a balance now costs a lot more. Carrying a balance is probably one of the, let's say, number one ways to get yourself into debt. I mean, it is sort of debt. That's why I would always encourage, and it's also the advice you hear from a lot of financial experts or, let's say, gurus or maybe non-gurus online, never carry a balance. A lot of times you might hear people like Dave Ramsey saying that they don't believe in credit cards. I don't think it's that he necessarily doesn't believe in credit cards, but statistically speaking, more people probably carry a balance than not. So if you can't really create the discipline to make sure you're paying that credit card off in full every month, it's probably not good to have debt and have that balance, because when the federal fund rate goes up, you're going to have to pay a lot more on that balance. Okay, mortgage rates rise, meaning higher monthly payments. Now, in this recent case, the Fed cut the rates. Mortgage loans are the lowest they have been in over a year. So I just want to contrast it there a little bit. And that's what I was saying. When the Fed fund rates go up, the mortgage rates increase. But now, because the Fed cut the rates, we can see that mortgage rates, like it says here on this website, Bankrate, mortgage rates dip again to lowest level in a year. We can see here mortgage rates, the national average for 30-year mortgages was 6.25 as of October 29th. Right, so this is October 29, 2025. It is 6.25. But if we look like way back, let's see, 30-year mortgage on October 25th, 2023, it was at 8%. Right, so it has been the lowest it has been in over a year, which is great news. And hopefully, obviously, it continues this way because we can at least get more people into home ownership, which I think a lot of people still deem to be the American dream. But of course, we will see what happens in the future. And I will again revisit that exact piece, what happens in the future, in just a little bit. Okay, let's talk about auto loans. So auto loans, personal loans, and student loans get pricier. So if we open up another article here from the Houston Chronicle, what a Federal Reserve rate cut means for your finances. And I just want to quickly go over some of the finances here. Not the finances, the headings that I was looking at. So for example, interest on savings accounts won't be as appealing. So when the Fed cuts the federal fund rate, interest rates on savings accounts decrease. So it actually makes savings accounts a little less appealing. When the federal fund rate increases, then the savings accounts become more appealing. So you might see more people moving their cash into these accounts because the interest rates are higher. Okay. Now, a cut will impact mortgages gradually. So for prospective home buyers, the market has already priced in the rate cut. Mortgage rates in particular have responded swiftly. Just in the past week, they fell to the lowest level in over a year, which is what we just saw from that Bankrate website. Auto loans are not expected to decline soon. Credit card relief could be slow. So you can see sort of what we talked about a little bit earlier, right? Credit cards, mortgage rates, auto loans, all these things are heavily affected and guided by this federal fund rate. So anytime, let's say Jerome Powell right now, for example, makes a speech about the federal fund rate, it's something that you as a consumer should pay very close attention to because it has a direct impact on how you live your life. The borrowing that you do, the savings that you do, what exactly you're buying at any given time, how you're buying, how you're spending. So it's kind of interesting that once you get this idea in your head, I think you can sort of change the way that you're buying and spending and saving as the, let's say, federal fund rate moves, which I think is a smart thing to do. It's kind of getting to that like enlightened investor type of stage, which if anything is what I want you all to think about and get into the mindset of. So going back to our notes here, businesses through borrowing costs and investment decisions. So loans and credit lines cost more when the Fed rate goes up, slows down hiring or investment plans. And again, you can think of the opposite if the rate goes down, right? So loans and credit lines cost less in that case. And it will probably speed up hiring or investment plans, right? If it's very difficult to invest in your business because the fund rate is so high, you as a business owner will probably want to slow that down for a little bit. You won't be hiring as much. You won't be investing in the business as much. It's hard to take out loans and credit lines, for example. So it kind of makes a lot of sense. Let's talk about investors now. For investors, since the stock and bond markets react to rate changes, right? This is how investors are affected. If the rates go up, stocks drop because borrowing costs go up and future profits are worth less in today's dollars. Cash and savings become more attractive and investors might pull away from riskier assets. Okay? Just like we talked about, if the rates go up, cash and savings become more attractive because those savings account will be guided by the Fed fund rates. So if they go up, savings accounts interest goes up, it might be easier or let's say more attractive for you to move that money into a savings account if that's, let's say, what you want to do and if it matches your risk tolerance. Again, I think it always comes down to that. Now, forward guidance can also affect general market sentiment because I want to talk about this, right? If we go and read this website right here, the Dow ends down. This is Reuters, by the way. I never really know how to say it, but let me make sure this is on mute. Okay, Dow ends down. S&P 500 flat as Powell says December rate cut far from assured. So this is really just the headline I wanted to mention here. You can imagine here that if the rates go up, the stocks drop. But in this case, the rates went down, so we should have seen the rates go up, right? Well, this is what I want to point out here. Forward guidance can also affect general market sentiment. So if we read this, the reason that the stock sort of ended flat or went down is because the cuts happened, the rates went down, but Jerome Powell said, I'm not really sure what's going to happen in December, because in December there's supposed to maybe be another rate cut, but because he was unsure and there was a little bit of ambiguity, it sort of made investors a little bit scared, a little bit nervous, which is why we see this negative reaction in the stock market. And I just want to pull up the exact moment here that he said it, so let's pay attention real quick here.
As I pointed out in my remarks, and that's what leads me to say that that we haven't made a decision about December. I always say that it's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
So it's not to be seen as a foregone conclusion, in fact, far from it. So while everyone is anticipating this cut to happen in December, now we're saying, well, it might not actually happen. So you can imagine that investors might become a little bit scared, a little bit weary, the market's going to fall flat. And that's why despite the fund rate going down, we might have expected the stock market to actually look good and healthy, but it actually continued to go down. That's why recently, I think even today was a pretty mixed day, maybe a little bit more on the negative side. So we really just have to now wait till December and see what happens. Okay, so how does this all work in practice? Well, the Federal Open Market Committee, FOMC, meets roughly every 6 weeks to decide the rate. So if we go here, we can literally look on their calendar, and if we scroll down to October, we can see October 28, 29, there's the statement with the PDF, HTML, implementation notes, we can see the press conference, so this gives us the entire schedule. And look at this, we can actually see in December, there might be one from the 9th to the 10th, but we're not entirely sure yet, right? It's still up in the air. And even Jerome Powell said, far from it. We're not entirely sure if something will happen in December, so we might just have to wait. Maybe November will be a rocky month. Maybe things will continue going down. Maybe they'll go up, right? So many factors that can influence the stock market and all these different types of, let's say, financial topics, if you will. Okay, so they don't set it directly, but they use tools like open market operations, like buying and selling government securities to guide where the rate lands. So if the Fed buys bonds, they put money back into the banking system. Banks now have more reserves and they can lend more, and thus the interest rate lowers. And if the Fed sells, they take money out of the banking system. So banks now have less reserves, not reverses, reserves, and this increases the rate. Okay, so with all this being said, I think in short, and I really want you guys to take this key point of advice here, not really advice of knowledge, right? If the Fed raises the rate, loans cost more, but savings account earn more. If the Fed lowers the rate, loans cost less, but savings yields drop, right? That's exactly what we were talking about earlier, those savings account. The Fed raises the rate, people might stop taking loans out, and they're going to try and move maybe more of their money into savings account because those interest rates are up. They're going to be getting more interest on that money that's sitting there. If the Fed lowers the rates, then the loans cost less, but the savings yields also drop. So maybe now you might start moving money to a different place instead of the savings account. So this is the new framework. The video did end up being a little bit shorter than normal, which I'm very happy about. And I feel like at least in this way, I'm able to communicate with you a little bit more clearly. And, in hopes that all of you walk away from this video at least now knowing just a little bit more about the federal fund rate. So let me know in the comments below if you like this new format. Do you think I could shave off even more and make it even shorter? I think that'll probably be my goal long term. But anyway, I'm just really happy I was able to make the video today. And with all that being said, I hope you all have a great Halloween. By the time you're watching this video, it's already going to be Halloween. So I'm very much looking forward to that. I hope you guys are all looking forward to that. And yeah, with all that being said, I will see you all next time. Take care.